Dividend ETFs sound like the perfect investment, right? You buy a fund, you collect easy cash, and you watch your wealth grow. But what if I told you many of the dividend ETFs out there with the highest yields are actually dividend traps? In this video, I will show you some of the safest ETFs that you can buy and maybe one or two that you should avoid. But hey, if you're looking for deeper insights in how we analyze dividend growth companies, then feel free to grab a free sample of our newsletter in the link below. Now, before we start, I do have to make a disclaimer and say I don't own any of these ETFs and I don't actually own any ETFs at all. And that's mainly because in Ireland, the tax can be a little bit of a nightmare. However, I do feel for most people, they should be a fundamental part of any portfolio. Now, what I will say about dividend ETFs is that dividend growth is actually not that common with them and they are prone to dividend cuts. So when you're looking at ETFs, it's better to look at the total return. Now, the first ETF on my list is the Vanguard FTSE All World High Dividend Yield. Now, this is an accumulating fund and the ticker symbol is VGWE. Now, as the name suggests, this ETF aims to track the high dividend yield index of global equities. Its total expense ratio is only 0.29% and it currently holds around €881 million in assets under management. In terms of its top 10 holdings, there'll be names that you will be familiar with, such as JP Chase, ExxonMobil, P&G, Johnson & Johnson, Home Depot, AbbVie, Coca-Cola, Chevron, and even Wells Fargo. And actually 41.13% of their companies come from the United States, but they're also well diversified across Japan, United Kingdom, and Switzerland, just to name a few. Now, the company currently pay €2.09 in dividends, which means they have a current yield of around 3.42%. The 5-year dividend CAGR is only 2.19%, so there's not a lot of dividend growth. However, over the same 5 years, the company's total return has been 76.26%. So from a total return perspective, it's actually really decent. The second ETF on my list is the iShares MSCI World Quality Dividend Advanced ETF. Now again, this is an accumulating fund and the ticker symbol is AYEG. Now this fund is a little bit more expensive than the last ETF and its total expense ratio is 0.38%. Its current dividend is 0.18 cent, which at current prices gives it a current yield of 2.52%. You don't get much growth from dividend either, as its 5-year CAGR is only 0.64%. Its top holdings include companies like Apple, SAP, Johnson & Johnson, Nvidia, Cisco Systems, Home Depot, Novartis, Essentia PLC, and even Qualcomm. Now, from a total return perspective, on just ETF, it doesn't show that it has a 5-year return for the accumulating ETF. However, if I look at the equivalent distributing ETF, I can see over the last 5 years, it has returned 63.2%, which is not actually too bad. Now, before I jump into the last ETF, my good buddy European DJI did an excellent article on 18 dividend ETFs. Now I'll put a link to it in the description below, but in this there's a G sheet where he outlines 18 different ETFs and compares them in terms of expense ratio, dividends, dividend yield, and even its 5-year dividend CAGR. Now the final ETF I want to talk about is the Fidelity US Quality Income UCITS, ticker symbol FUSA. Now again, this is also an accumulating ETF. This ETF simply aims to track the Fidelity US Quality Income Index. Now the company's expense ratio is only 0.25%. Its current dividend is around 20 cents and at current prices that gives us a dividend yield of 1.94%. However, over the last 5 years, it does have a dividend CAGR of around 6.6%. Again, its top 10 holdings will be names that you are familiar with, such as Apple, Nvidia, Microsoft, Meta, Broadcom, Eli Lilly, JP Chase, Visa, and MasterCard. One of the main differences between this ETF and the last two ETFs is that this is mainly concentrated in the United States. So 93% of its 110 companies reside in the United States, whereas the last two ETFs were a little bit more balanced. In terms of performance, this fund has been down 13% year on date. However, over the last 5 years, it has returned 86.21%. So this actually looks quite good when you compare it to the other two in terms of both dividend yield, dividend growth, and total return. So I did say I wanted to warn you about some of the high yielding ETFs that can be dividend traps. And one such example of this is Global X Super Dividend. I mean, if you look at that name alone, you would think that it is very enticing, especially for a dividend investor. The ticker symbol is UDIV, and it seeks to track the Sol Active Global Super Dividend Index. Now, its top 10 holdings are honestly companies I've never heard of. And they include companies like HKBN, Yuyun Industrials, Dilly Group, QCRCB. In terms of dividend yield, it yields around 11.25%, which you might think is pretty attractive. However, from a total returns perspective, if you actually held this for the last 5 years or since inception, you actually would have lost money. It's down 8.59% year to date, but since inception, it's actually down 22.90%. So just because it pays high dividends does not mean that this would be a good investment. Now, many of our American friends will be able to invest in funds like SCHD. And honestly, if I could easily invest in this type of fund, hands down, I would not even think about it. It would be 50% of my portfolio. However, as a European investor, it is not so easy to access them. There are ways, but there might be some risks associated with them. So I've ignored that for this type of video. One of the other type of funds that is quite popular is JEPI. Now again, JEPI is quite popular because it has high dividend yield. And over the last few years, I've noticed that investors looking for income tend to gravitate to some of these types of ETFs. Now again, as a European, it's quite difficult to obtain these type of ETFs. However, there is an alternative. Now this is the JP Morgan Nasdaq Equity Premium Income ETF. Now it has a total expense ratio of 0.35% and it generates its income using derivative financial instruments, or otherwise known as option trading. There is not much information based on its dividend history or its total return history because it is a relatively new fund. You can probably look towards JEPI in the United States to get an idea of how it will work. However, I would exercise some caution, especially if you're not too sure on how these financial instruments work. So while it sucks European investors find it difficult to invest in ETFs like SCHD, my top ETF would be the Fidelity US Quality Income. If I was to only give you one piece of advice when investing in ETFs, it would be stick to total returns, maximize your tax efficiency, and forget about chasing high dividend yields. With that said, in this channel, we are more interested in dividend growth companies. And if you want to hear more about those type of companies, please hit that like button and hit that subscribe button. And we'll be talking about plenty of them in the future. Thanks a million for listening, and we'll see you all next time.